Hello, I am Bob. This is my channel about success, money and investment. Today I will introduce you to the main ideas of The Intelligent Investor, a book by Benjamin Graham. Benjamin Graham was one of the greatest practical investment thinkers of all time. In The Intelligent Investor, little time is spent discussing the technique of analyzing securities. Instead, great focus is placed on investment principles and investors' attitudes. Although The Intelligent Investor was first published in 1949, the underlying principles of good investment do not change from decade to decade. Before we move on, don't forget to hit the subscribe button and the like and share the video if you find it helpful so others can benefit from it as well. To be an intelligent investor, you must be patient, disciplined, and eager to learn new things. You must also be able to control your emotions and to think for yourself. There are 3 principles to becoming an intelligent investor. Often also called value investing, intelligent investing according to Benjamin Graham rests on 3 principles. 1. An intelligent investor always analyzes the long-term evolution and management principles of a company before investing. 2. They always protect themselves from losses by diversifying investments. And 3. Intelligent investors never look for crazy profits, but focus on safe and steady returns. Value investing is deriving the intrinsic value of a common stock independent of its market price. Analyzing a company's assets, earnings, and dividend payouts can help identify the intrinsic value of a stock, which can then be compared to its market price. There are 2 types of investors according to Graham, the defensive one and the enterprising. Most people are better suited for the defensive strategy, as the time they are willing to dedicate to investing is limited. The investor should create a portfolio with a mixture of bonds and stocks, say 50% stocks and 50% bonds. Restore this allocation once or twice every year, so that if stocks suddenly make up 60% of the portfolio compared to only 40% in bonds, sell stocks and buy bonds, until 50-50 is restored. The bond-stock split was just another way of saying investors shouldn't keep all their eggs in the same basket. There's your margin of safety again. Graham also advocated for an investing approach that provides a margin of safety or room for human error for the investor. There are a couple of ways to accomplish this, but buying undervalued or out-of-favor stocks is the most important. The irrationality of investors, the inability to predict the future, and the fluctuations of the stock market can provide a margin of safety for investors. Investors can also achieve a margin of safety by diversifying their portfolios and purchasing stocks in companies with high dividend yields and low debt-to-equity ratios. A formula used in the book can give you some heads up regarding what the value of a company is, and therefore also if it can be bought with a margin of safety. The growth rate should be equal to the expected yearly growth rate of earnings for the next 7 to 10 years. Lesson 2, Never Trust Mr. Market. Graham's most famous analogy is the one of Mr. Market, where he pictures the entire stock market as a single person. If you imagine Mr. Market showing up on your doorstep every day, quoting you different prices for various stocks, what would you do? About a month before a new iPhone is released, stocks rally while people queue in line in front of the Apple Store. But when the new phone is not exactly as expected, stocks can plummet the very next day. Graham advises you to invest only if you would feel comfortable to hold the stock in the future without seeing the fluctuating prices that Mr. Market presents you with. But for the investor who can keep his head cool, Mr. Market presents a great possibility of making money, for he doesn't force you to strike a deal with him. He merely presents you with an opportunity of doing so. You should be happy to sell to him when he offers prices that are ridiculously high, and similarly, you should be happy to buy from him when he presents you with bargains. If you want to be an intelligent investor, rely on your own research of history of the company and ignore the market altogether. Lesson 3, No emotions, always stick to the same formula. To further remove you from the emotional stress of investing with the market, You should always stick to a strict formula when investing. Graham calls it formula investing, but it's more widely known as dollar cost averaging. What it means is that you simply set a fixed budget you're going to invest every month or quarter, and then invest that into the stocks you've previously picked, no matter the price. For example, I invest 10% of my income every month. That money goes to my investment account on autopilot, and then I invest it in the stocks I already own. This is somewhat emotionally demanding, because it requires you to invest the same amount again and again, no more when stocks are cheaper, no less when stocks are expensive. But once you get over it, it's a great way to protect yourself against losses, which could happen if you invest a big sum right before a crash. If you liked the video about Benjamin Graham's The Intelligent Investor, like and subscribe to my channel to be the first to get the updates about money, finances, investing, and being successful. I'll walk you through this all step by step.